Hello traders and welcome to Trade with Ali Akbar. In this video I'll delve into a static and dynamic support and resistance trading strategy. We'll begin by identifying various trading patterns such as horizontal, wedges and triangle formation. Additionally, we'll explore dynamic support and resistance trendline and moving averages trading technique. Next, I'll demonstrate how to draw static and dynamic support and resistance levels on your price chart and explain how the price typically reacts when it reaches these levels. Throughout, I'll provide insight into entering and exiting trades and safeguarding your asset through proper stop loss and profit target implementation for effective risk management. Whether you are a novice or an experienced trader, incorporating these concepts into your trading strategy will significantly enhance your ability to navigate financial market successfully. Remember to share this valuable information with your trading community. Let's elevate our trading skill together, so sit back, relax, and let's get started. What is support and resistance levels? Support is an area where buyers want to push the price higher, or support can be referred to a price level where a downtrend to find difficulty falling below. When the price reaches this level, buyers are more likely to buy, preventing the price from declining further. Support levels are often seen as opportunities to enter the trade or go long. Resistance is an area where sellers want to push the price lower, or resistance can be referred to as a price level where uptrend struggle to surpass. When the price reaches this level, sellers tend to sell, preventing the price from rising further. Resistance levels are often seen as opportunities to exit the trade or go short. Support and resistance levels can indeed be categorized into static and dynamic levels. Static support and resistance levels. These are price levels that remain relatively constant over time and are represented by horizontal lines on a chart. Static support and resistance levels are typically based on historical price action where significant buying or selling pressure has been observed. Traders often look for these levels as potential area for price reversal or breakout. Dynamic support and resistance levels such as trendline and moving averages. These levels are more fluid and change over time as they are based on mathematical calculations or trend analysis. Trend lines are drawn by connecting higher lows for uptrends or lower highs for downtrends, and they represent dynamic levels of support or resistance that follow the trend directions. Moving averages such as the 50-day or 200-day moving average are calculated averages of past prices and can act as dynamic support or resistance levels, particularly during trending markets. Support and resistance can also swap their role. What it means is these levels are not fixed or absolute. In certain market conditions, what was previously a support level may become a resistance level, and vice versa. This phenomenon can occur due to various factors, including changes in market sentiment, shifts in supply and demand dynamics, economic news, or changes in investors' behavior. How to draw support and resistance levels on a chart. Here are 7 guidelines to help you draw them effectively. Number one, zoom in on your chart to get a clearer view of price movement. This allows you to identify key levels more accurately and reduce the chance of missing important support and resistance points. Number two, avoid overcrowding your chart with too many lines. Focus on drawing only the most significant and obvious support and resistance levels. Too many lines can confuse your analysis and make it difficult to identify meaningful price levels. Number three, draw lines based on price action that is clear and obvious to you. If you are unsure about a particular level, it's better to leave it out rather than force a line that may not be relevant. Number four, support and resistance levels are not static and can change over time as market conditions evolve. Continuously monitor and adjust your levels as needed based on new price data and market development. Number five, draw lines at price levels where significant buying or selling pressure has been observed in the past. Look for areas where the price has repeatedly bounced off or struggled to break through. Number six, support and resistance levels may vary depending on the time frame you are analyzing. Consider drawing levels on different time frames to get a more comprehensive view of the market dynamics. And finally, number seven, look for confirmation of support and resistance levels through multiple factors such as volume, chart patterns, and trend lines. The more confirmations you have, the stronger the level is likely to be. Different ways to draw support and resistance levels. Horizontal support and resistance levels are drawn as a straight line across the chart at price level where significant buying or selling pressure has been observed in the past. These levels are static and remain relatively constant over time. Traders often look for price bounces or breakout at these levels. Wedges are chart patterns formed by converging trend lines, either sloping upward ascending wedge or downward descending wedge. These trend lines can act as dynamic support and resistance levels, offering insight into potential price reversal or continuation. Dynamic trend lines are drawn by connecting consecutive higher lows in an uptrend or lower highs in a downtrend. These trend lines represent dynamic support or resistance levels that changes over time following the trend direction. Traders often use dynamic trend lines to gauge the strength of the trend and identify potential entry or exit point. Moving averages such as simple moving average SMA or exponential moving average EMA are calculated averages of the past prices. They can act as dynamic support or resistance levels, particularly during trending market. Moving averages smooth out price fluctuation and help traders identify the underlying trend direction. Traders often use crossovers of different moving averages or price interactions with moving averages to identify potential trading opportunities. How to draw horizontal support and resistance levels. In my analysis of ERF stock on a daily time frame, I have adhered to several key rules that I explained in detail in my previous slide to draw support and resistance level effectively. Initially, I identified three significant horizontal levels over the past year. The first is a resistance level with 7 touches, indicating a barrier that upward trending assets struggle to surpass. This level often serves as a potential area for price levels or price reversals, offering opportunities for short trades. The second horizontal level is a support resistant level with more than 7 touches where rolls appear to swap over time. Initially acting as resistance, it transitioned into support before reverting to resistance again. This dynamic nature suggests potential trading opportunities as price interact with this level. Finally, the third horizontal level is a support level with more than 8 touches, signaling a gradual weakening of sellers' power and a shift toward buyers gaining control. This presents potential opportunities to enter long positions as buyers assert dominance. To refine my analysis, I have chosen to zoom out on the third support level to identify these two specific entry points for long positions. This focused view will offer clarity and aid in pinpointing optimal entry opportunities. In revising my analysis, I'll also consider examining other aspects of price action, such as chart patterns, to confirm my entry points. How to trade support and resistance levels. In this chart, I zoomed out to focus on the two specific points on the third horizontal support level we previously discussed. Here is a bullish double bottom reversal pattern is evident, with the neckline being a key component. The long significant bullish candle that appear here penetrate the neckline and closes above. It serves as an optimal entry point for the trade. To execute the trade, we would enter the trade at the close price of this bullish candle, and our stop loss would be 180R below the neckline to mitigate risk. Additionally, our profit target would be set at a level above this bullish candle that allow for a reward risk ratio of at least 2.5 to 1. This approach demonstrates how to effectively draw support and resistance levels and utilize them to enter trades based on significant price action patterns. What is trend lines and how to draw them on a price chart? A trend line is a straight line that it connects two or more price points on a chart. It's primarily used in technical analysis to visualize and identify the direction of the trend, and it may also help traders to gauge the strength and direction of the trend. In this graph, CL stock on a D1 time frame drawing a trend line involves identifying the prevailing trend, selecting significant highs or lows as anchor point, and connecting them with a straight line. For an uptrend, the line is drawn by connecting higher lows, while for a downtrend, it connects lower highs. The trend line is then extended into the future to gauge potential support or resistance levels. Validation of trend lines involves observing multiple touches by candlestick shadows or bodies. Adjustment may be made if necessary to better fit the price action while maintaining the overall trend direction. Trend lines serve several purposes in technical analysis. First, trend lines help traders and analysts determine whether a market is trending upward, downward, or moving sideways. Second, trend lines often act as dynamic support or resistance levels where the price trend to bounce off or encounters resistance when approaching the trend line. Third, traders use trend lines to identify potential entry points for buying or selling positions as well as exit points to close exiting positions. Finally, number 4, breakout or violation of trend lines can signal potential trend reversal, indicating a shift in market sentiment. In this example, we examining the Euro-Canadian dollar currency pair on an H1 time frame where the trend initially shows an upward trajectory marked by higher swing high and higher swing low all the way up, indicating an uptrend. This upward momentum is further accentuated by drawing a dynamic support trend line with more than 4 touches solidifying its validity. However, at the apex of this trend line and the last pullback, this bearish candle break this trend line and close below it. This bearish signal is reinforced also by the SMA 42 with the same bearish candle penetrate the SMA 42 and close below it. In this context, it is prudent to consider exiting the trade at the close price of this bearish candle and placing our stop loss 280R above the dynamic trend line, and for our profit target we aim for a level below that ensure a 2-to-1 reward risk ratio. Following our exit, we observe the trend continuing its downward trajectory, validating the success of our decision to exit. This approach demonstrates the effectiveness of trading trend lines when executed properly. In this section, I'm going to talk about rising and falling wedge pattern. But first, bearish continuation rising wedge pattern. Rising and falling wedges are two distinct chart patterns that traders often look for when analyzing price action. Here are some definitions. A bearish continuation rising wedge pattern typically forms within a downtrend. Here is how it appears. It consists of converging trend lines slanting upward, where the upper trend line is steeper than the lower one. The price oscillates between these two lines, forming a narrowing wedge shape. The volume tends to decrease as the pattern progresses. This indicates diminishing interest from buyers. The breakouts typically occurs to the downside. A breakout below the lower trend line is considered a signal for potential short trades, anticipating a continuation of the downtrends. Bearish reversal rising wedge pattern. A bearish reversal rising wedge pattern typically forms within an uptrend. Here is how it appears. Similar to the bearish continuation rising wedge, it consists of converging trend lines, with the upper trend lines slanting less steeper than the lower one, forming a narrowing wedge shape. The volume tends to decrease as the pattern progresses, similar to the bearish version. This indicates weakening buying pressure. The breakout usually occurs below the lower trend lines to the downside, signaling a potential reversal of the prior uptrend and the beginning of the new downtrend. Bullish continuation falling wedge pattern. The bullish continuation falling wedge pattern typically forms within an uptrend. It typically looks like this. It consists of a converging trend lines slanting downward, where the upper trend line is steeper than the lower one. The price oscillates between these two lines, forming a narrowing wedge shape. Volume tends to decrease as the pattern progresses, indicating a decrease in selling pressure. The breakouts occur to the upside. Once the price breaks above the upper trend line, it signals a continuation of the prior uptrend and a signal for potential buy trades. Bullish reversal falling wedge pattern. The bullish reversal falling wedge pattern typically forms within a downtrend. Here's how it looks like. Similar to the bullish continuation falling wedge, it consists of converging trend lines slanting downwards. The lower trend line is steeper than the upper one, forming a narrowing wedge shape. Volume tends to decrease as the pattern progresses, indicating a decrease in selling pressure. The breakouts occur to the upside once the price breaks above the upper trend lines. It signals a potential reversal of the prior downtrend and the beginning of the new uptrend. In this section, I'm going to talk about ascending and descending triangle pattern. First, in ascending triangle, the higher lows into resistance results break out. An ascending triangle pattern typically forms within an uptrend. It consists of a horizontal resistance line and a convergent trend lines slanting upward. Price fluctuates between these two lines, with the horizontal resistance line and the ascending trend lines being touched at least twice to be valid. The more touches these lines receives, the more reliable the patterns become. As the patterns develop, volume often decreases, suggesting diminishing selling pressure. The breakout usually occurs to the upside. A breakout above the resistance line is considered a signal for potential long trades, anticipating a continuation of the uptrend. In descending triangle, the lower high into support results break down. A descending triangle patterns typically form within a downtrend. It consists of a horizontal support line and converging trend lines slanting downward. Price fluctuates between these two lines, with the horizontal support line and the descending trend lines being touched at least twice to be valid. As the patterns develop, volume often decreases, suggesting diminishing interest from buyers. Eventually, the breakout typically occurs to the downside. A breach below the support line signals potential short trades, anticipating a continuation of the downtrends. In this example, let's focus on CSV stock. Observe on a D1 time frame, we notice an ascending triangle pattern with the price oscillating between the dynamic support trend line and horizontal resistance levels over a span of several months. As this price action unfolds, bullish momentum gradually builds, eventually leading to a breakout above the resistance level. The breakout occurs with this strong bullish candle. This strong bullish Marabozo candle signaling a significant upward move, followed by this retest of the previous resistance, which now acts as support. The subsequent bounce off this support is confirmed by this bullish hammer pin bar closing above the bullish candle initially broke the resistance level. Additionally, SMA 50 provides further insight into trend behavior, initially showing an upward trajectory followed by a period of consolidation indicating by this straight line, and finally a slope upward post breakout. With this indication in mind, it is compelling to consider entering the trade at the close price of this bullish pin bar, placing our stop loss 180R below the bullish candle initially broke the resistance level, and for profit target we set it at the level above to ensure 2-to-1 reward risk ratio. This strategy exemplifies how to effectively trade an ascending triangle pattern, capitalizing on breakout opportunities with careful risk management and profit target placement. Next, I'm going to talk about moving averages. But first, what is moving average? Moving averages are mathematical calculations that average a series of past data points to create a single smooth line. They are often used to identify the underlying trend in price movements, filtering out short-term fluctuations, and provide a clearer picture of the overall direction of the market. Traders use moving average to identify support and resistance levels, confirming trend changes, and generating buy or sell signal. Common types of moving averages include simple moving average, SMA, which equally weigh all data points in the calculations. Exponential moving averages, EMA, which give more weight to recent data points. Optimal moving averages for support and resistance. A moving average is considered to fit a price trend when it accurately reflects the general direction of the price movement over a specific period. Choosing the right moving averages depend on the trader's strategy, time frame, and characteristics of the market being analyzed. Here is the general guideline. Short-term trends. Traders often use shorter-term moving averages such as the 10 or 20 days period, since they respond more quickly to recent price changes and are suitable for capturing short-term price movements. Medium-term trends. Traders may also use medium-term moving averages such as 50 or 100 days, which they can provide a balance between responsiveness to price changes and smoothing out short-term fluctuations. Longer-term trends. Traders are typically identified using longer-term moving averages such as the 200 days. These moving averages are less sensitive to short-term price fluctuations and are better suited for capturing the underlying long-term direction in the markets. Exponential moving averages. In highly volatile markets, traders may use exponential moving averages instead of simple moving average because exponential moving average give more weight to recent price data, making them more responsive to changes in volatility. Application of moving averages. Moving averages serve several purposes in financial analysis. First, trend identification. Moving averages help identify the direction of the trend by smoothing out short-term price fluctuations. In an uptrend, price trend tends to stay above the moving averages, while in a downtrend, price tends to stay below the moving average. Support and resistance levels. Moving averages can act as support or resistance levels. For example, during an uptrend, the moving average may act as support, while during the downtrend, it may act as dynamic resistance, where the price tends to bounce off the moving average during the pullback in the direction of the trend, indicating its relevance as a trend following indicator. Crossover signal. When a short-term moving averages crosses above the longer-term moving average known as golden cross, indicating an uptrend and generating a bullish buy signal. Conversely, when the longer moving average crosses below the shorter moving average known as death cross, indicating a downtrend and generating a bearish sell signal. Finally, entry and exit point. Traders use moving averages to identify general entry and exit point. A trader may buy when the price crosses above a moving average or sell when a price crosses below a moving average. In this example, focusing on British pound Canadian dollar currency pair on an H1 time frame. I'll illustrate the diverse application of moving averages as discussed in previous slides. I'm utilizing a 15-day and a 50-day moving averages as depicted in the graph. During a downtrend, price typically remain below both moving averages, then serves as resistance levels. Conversely, in an uptrend, prices tend to stay above these two moving averages, establishing them as support level. When prices approaches the moving averages and rebound from them, it may indicate a continuation of the prevailing trend. The crossover of the SMA 15 above the SMA 50 is interpreted as a bullish signal indicating a potential upward momentum as evident in the graph, signaling an uptrend. Conversely, when the SMA 15 crosses below the SMA 50, it suggests a potential downtrend and generates a bearish signal. Entering a long position might be considered when the shorter term moving averages crosses above the longer term moving average and the price position above this crossover point. This bullish signal can be further confirmed by other technical indicators such as MACD or RSI. In the subsequent slide, I'll demonstrate how to successfully execute a long position entry. In this slide, I'm about to execute a successful trade using the same British pound against the Canadian dollar currency pair, but this time on a 30-minute time frame instead of hour time frame. I identify the moving average crossover located at 1.6921 at this location, and the close price of this bullish candle, the close price of this bullish candle above the crossover is located at 1.6955. Notably, the average true range for this bullish candle is recorded at 13 pips. Given this setup, I decided to enter the trade at the close price of the bullish candle, this bullish candle, above the crossover as indicated upward momentum. To manage risk, I place my stop loss order 180R below the crossover point. For my profit target, I aim for a level above the bullish candle, ensuring a favorable 2.5 to 1 reward risk ratio. Subsequently, the trend continues its upward trajectory, further validating the effectiveness of our successful strategy and timing our entries. This successful trade exemplifies the importance of strategic planning and risk management in achieving profitable outcomes. That's all, folks, for today. Thank you for watching this video until the end. I trust you find the insight provided valuable. I appreciate your continued support. Please consider liking, sharing, and subscribing to stay informed about future content. That's all, folks. If you found value in this presentation, give it a thumbs up, share and subscribe for future updates. Thanks for watching. Take care and see you next time.